Hello, Hamish here from mortgagesonline.co.nz. I'm here to talk to you today about interest rates. Interesting enough topic, sometimes. Other times it's fairly boring, bland, but when you're about to fix a rate, you got to make a call. And sometimes that call is, you could flip a coin. And don't ever underrate flipping a coin for how accurate it is with forecasting. But if you do like a little bit of drama and a little bit more of a story before you flip a coin, or before you decide, then stick around, because I'm going to tell you exactly what I think will happen to interest rates. And most of you probably know my views on that. It's always been the same, that interest rates will go up and then down, but maybe not in that order. But if you talk to most people, they might think interest rates are going to do something like this. Something like that, right? That's over, this is years, that's interest rate. So most people, if you talk to them, they think it's probably going to go down and then head up at some point. Because let's face it, low interest rates, as New Zealanders, we don't think we deserve them, do we? We think they should be a lot higher, sadly. I don't think like that, but a lot of Kiwis do. But look, if you do think that this is what's going to happen to interest rates, if you think this is the way it's going to roll, the crazy thing is, a lot of people think that's what's going to happen, but they're still fixing for 1 to 2 years, maybe even 3 years. Now let's think about that, because if you think that's what's going to happen to interest rates, and you fix for 1 to 2 to 3 years, this is not going to work out for you, is it? You'll probably just be coming off a fixed rate, and then the rates will be going up. And you probably miss out on the little dip here. See that little dip? Probably miss out on that. Now, it's scary though, isn't it, fixing long? If you think that's what's going to happen to interest rates and you have to fix long, well, you're paying a premium from the start, because your 4 and 5 year rates right now are around 4.3 to 4.5, which, you can't see 4.5 there because it's hidden behind my face there, but 4.5, let me write that down. Still pretty low, but that's your 4-5 year rate, whereas your 1, 2 and 3 are all running around your 3.9 kind of mark, right? So yeah, you pay a bit of premium from the start for this 4 to 5 year rate. There is a compromise though. You could always split your lending, so you could go 50% for 1 to 2 years, so that you enjoy a little bit of the dip there, and then 50% you could maybe go long, right? So you kind of hedge your bets and take the best of both worlds. Now, my thoughts about what interest rates, what could happen. Now, I'm just going to flip over to a blank screen here. First of all, what affects interest rates? You got things like the economy, of course, which is fairly important, but more important than that lately has been the central banks all over the world, right? So what have you got? You got the Bank of England, you've got the Federal Reserve in the US, and then you have got, of course, the European Central Bank, and then you got a whole bunch of them, right? You get the picture. But anyway, our bank, Reserve Bank of New Zealand, right? What I've noticed is at times they will be closely watching what is happening here as well. Because if they go too out of step, the currency is affected. Now, what has been happening is the Federal Reserve, the US basically, right? What they've probably found, a couple of years ago they thought, the central bank there said, we're going to start putting rates up, okay? But then they found that the Trump was probably not so kind to the economy, and things haven't been going as strongly as they'd like. So now what they've actually done is they've gone, whoa, hold on that. we're going to start to maybe keep it a little bit flatter for longer. So that's one thing that's come out of the US. Bank of England, they've also been very kind of like, pointing towards lower interest rates, mainly because of one key thing, Brexit. Basically, they've been saying, look, Brexit's going to cause a little pain, but we'll soften the blow by either printing money or keeping low rates. Now, this, I think, is the only, this thing here is going to have a fairly major impact on interest rates, I reckon. Because if Brexit is cancelled, which could happen, if Brexit gets cancelled, then I think you would have some grounds for interest rates in Bank of England maybe not going up straight away, but definitely not going down, which may lead to us speculating that interest rates should be higher. Okay, so even though everyone is going on about low interest rates, they're all going to drop, there are factors out there which can affect interest rates. Brexit is one to watch. Trump and the US, you could, who knows, I can't speculate on that. Our own domestic economy, you've got a lot of different things going on. You probably don't need me to remind you about the state of the Auckland housing market. But of course, our domestic inflation, which has been stable but not too unhealthy. By that I mean painfully, a healthy inflation is probably not good for you and me because it means prices are going up by about 2% a year. And it's not far off that. So inflation is probably okay. If the outlook, which is pessimistic, doesn't eventuate, if the government especially starts to spend a lot of money and people start to spend a lot of money, then again you could see higher interest rates in the future. But again, all of this is speculation, and this is where flipping a coin comes in, because sometimes we can't get too carried away with this. At the end of the day, just kind of basically just flipping a coin and making a decision can lead to okay results in the long run. If you don't discount flipping a coin, because over the long run, over 10 or 20 years, when you make, sometimes you make a profit, sometimes you lose, it evens out over the long run, right? If you have a shorter space of time between now and when your mortgage is going to be completely paid off, then of course, you probably have less time for those bets to even out. But if you're looking at 10, 20 years and you're definitely going to have a mortgage, I wouldn't get too hung up on picking exactly the right fixed rate term every time. You know what I mean? And you can't. It's impossible. If you want to talk about interest rates, give us a yell. We're here to help you fix rates as well. But thank you for listening.